Well, what's the?
Wait, have you had to take out the smelling salts? Given
yeah, right. I mean,
we don't need it. We think we're one of the few people that are actually sober in such an environment like today, given where financial assets have moved over the last several years.
Okay, but with that, let's start with the bear case, and then we'll do the bull case for gold. Go ahead, do the bear case. What do you hear?
Sure. I think as we just talked about the Federal Reserve, I think gold obviously does not generate any yield. And so to the extent that the Federal Reserve lifts interest rates, it'll actually create a slightly higher opportunity cost for those who do hold gold. And then I think the second thing was just the movement of the financial assets and financial markets in general. I mean, if you look at U.S. equities, they've increased dramatically over the past several years. And in concert with that, you've had actually gold decline severely. And so we think that creates a massive opportunity where we think people are mispricing the risk in both sets of assets.
But people have been saying, gold bugs have been saying, there's a massive opportunity every time we have seen this big drop in gold. I mean, is there at some point, though, Ryan, is it $1,000 an ounce where you say, wait a minute, let's reassess?
Yeah, no, I think it's impossible to tell exactly where markets are going to end. But what I would point out is that the cost of gold production is around $1,000 an ounce just on a mine basis, and then if you start adding in interest and the rest of that, you start getting well beyond $1,100 to $1,200 an ounce. So it's very tough for miners to add additional supply.
So what are you recommending? People go out and buy bullion or buy gold mining stocks?
We say both. I mean, in our gold fund, we invest approximately 15% currently in gold bullion and the rest in gold miners. And what I would say is that the gold miners have been severely impacted, obviously, by the gold price. But we think they have levers to improve the profitability beyond the gold price, and those are the really companies we're focused on.
There was a report out, I don't know if you knew about it, back in 2012. It was by one, I believe, investment manager in TCW, Claude Erb, and then Campbell Harvey of Duke University. So they had predicted the plunge in gold prices back in 2012. Yeah. They were recently interviewed, and they said they actually see gold at $350 an ounce. That is not unrealistic. And they say gold may very well be a long-run inflation hedge. However, the long run may be longer than an investor's investment time horizon or even their lifespan.
Sure. No, what we would say is that you should take a long-term view on commodity prices. I mean, they're typically more volatile than general financial assets. But when we started the fund in...
But what's long, right? I mean...
Yeah, no, I think it depends. But what I would say is that when we started the fund in 1998, we had the very same commentary about gold and associated gold equities. And in fact, you actually had an equity bubble at the time, and we think it's very similar circumstances as today. People are dismissing the risks involved and are basically abandoning what we consider the safe assets.
How much of your own portfolio would you put into gold?
We recommend typically about 5%. So we obviously don't recommend that people go 100% or anything like that. But we think it's a nice diversifier to have. And frankly, it's uncorrelated with most financial assets. So it could provide some protection in any sort of downdraft.